Hello, this is Domenico with NOMICS, and we're going to look at one of the first models that you will take a look at within a micro or macro economic course. And that model is the circular flow of income model. It's a very simple model illustrating the interaction between firms and households and how they engage with each other in the resource and in the product market. It's also important to note that there are some assumptions within the model. And one of the main assumptions, that we're going to assume that it is a closed economy, meaning that this economy is not engaging in trade with another nation, effectively not engaged in the global economy. It is an isolated nation. The closest real-world example may be North Korea. And also, we're going to assume in the model that there are no leakages or injections, meaning that the economy will not expand or contract. And that's something I'll talk about perhaps in another video. So in the circular flow, we're looking at first the household. And the household is the entity that owns the factors of production. Right? The household owns factors of production. And factors of production is another word for, resources, which is another word for inputs. All right, effectively, in economics, these are the same things. Factors of production is the same as saying resources, the same as inputs. So the factors of production, and I'm just going to label this factors of production, include number one, labor. Number two, capital. Number three, land. And number four, entrepreneurship. Okay, so the factors of production are owned by the household. They own labor, land, capital, and entrepreneurship. Labor can generate a form of income. That form of income is a wage. If the household is offering their capital resources, they can generate a form of income that we call rent. Interest. My mistake. Interest. So in the form of financial capital, if you have money as savings in a bank, you can generate interest since the bank will be utilizing that financial capital for offering loans as investment, which will become an investment for a firm. So types of capital can generate interest. Land would generate rental income, and entrepreneurship would generate profit. Okay? Again, so factors of production or resources or inputs owned by the household, including labor. When the household offers labor to a firm, they're going to generate a form of income called a wage. If they're offering capital resources, such as financial capital, they can generate interest. If they own land resources, they can generate rent. And if they are the entrepreneur that are acquiring labor, capital, and land and managing those resources to generate some type of output or service, they can generate a profit. All right? So in the circular flow, here we have the household or the consumer of outputs, and the household is offering their resources in the resource market. So they can be offering their labor, their capital resources, their land resources, and their entrepreneurship. So I'll abbreviate that to LCLE: labor, capital, land, and entrepreneurship. What does the household get when they offer their resources in the resource market, which are later employed or are employed by the firm? They get a form of income. And that income can come, if it's for labor, can come in the form of a wage. If it's from capital, it can come in the form of interest. If it comes from land, it can come in the form of rent. And if it's for entrepreneurship, it comes in the form of profit. Okay? So that is income to the household. So the household is offering their labor. They go to the labor market. They will interview with different companies. They will try to maximize their utility by trying to acquire the highest wage for their labor, and then they will be employed by the firm. And the same thing for the capital, land, and entrepreneurship. The household is motivated in their pursuit to maximize utility to offer these resources at the highest price possible so that they can consume as much output as possible to improve their material well-being. So the land, labor, and capital through the negotiation process is then allocated to the firms that offer the highest amounts for those resources. Labor, capital, land, entrepreneurship, going to the firm that has been able to negotiate with the household to acquire those resources. From the household's perspective, they may feel that they're getting the highest income that they can get from the offering of those resources. But for the firm's perspective, they feel as if they're getting it at the lowest cost possible. But because of the asymmetries of information between the households and firms, they're not aware of that information. So I'll explain that when I go into the paper one analysis of this, or a paper analysis of this. So if the household generates income from offering their land, labor, capital, entrepreneurship, that is effectively a cost to the firm. It could be variable costs, fixed costs. Firms offer money to acquire those resources, which is a cost for them, but it becomes a form of income for the household. So for the firm, where it's kind of a negative value, they're paying for this, their money is leaving the firm, this becomes a positive for the household because money is coming into the household in the form of income. All right, so land, labor, capital going to the firm. Again, these are inputs or resources. What does the firm produce? It produces some type of output or some type of good or service. So we'll say goods and services generated by firms, which is a product, a type of product that's being produced. This is a type of output. All right, land, labor, capital, entrepreneurship, these are inputs. So inputs go into the firm and outputs come out of the firm. And firms offer these goods and services in the product market, where we go to shop in the shopping mall, at the supermarket, any type of retail store that we go to buy outputs. We're engaging with the product market. And households acquire those goods and services, and they take them home. Also known as products, also known as outputs. Okay. So what is the household offering to acquire those products? They're offering their spending. So this is consumer spending or consumer expenditure to acquire the goods and services. And households in the product market are trying to find the best deal. They don't want to offer all of their hard-earned income. They want to pay the lowest price possible. And for firms, they're going to try to sell their goods and services at the highest price possible. So the interaction between households and firms in the product market establishes an equilibrium price. And that price for the household will seem as if it's the lowest price that they could spend on the good, but for the firm, it may, from their perspective, it is the highest price they were able to offer in the product market. So if households are spending their income in the product market, that comes back to the firm as revenue. And later in theory of the firm, we'll talk about average revenue, which is your demand curve, and marginal revenue. Okay? So on the household side, they're spending money, so money's leaving, that's a negative. But on the firm side, money's coming in, so that is a positive. So we see that things balance in this circular flow. That is an assumption of this model. Some things that we can mention about this is that it can also help us understand income inequalities. Why is there a difference between poor and rich, low income and high income? This has to do with the number of factors of production that are owned by the household. If the household owns more labor, capital, land, and entrepreneurship resources, they generate more income in the form of wages, interest, rent, and profit. We see that with low-income households, typically they only own their own labor, and thus they can only generate a wage. And if it's low-skilled labor, they generate a low income or low wage. Other wealthier households not only have ownership of their labor, but they may own capital resources, land resources. They may be the entrepreneur of a particular firm, and thus they have several streams of income coming to the household to enrich that household and maximize their utility. Okay, so I'm going to go ahead and kind of analyze this circular flow as we would on a paper exam, and then we're going to take it a step further to introduce a concept in macroeconomics. All right, so let's go ahead and analyze this as we would for a paper exam. As can be seen in the circular flow of income model, we have households that own factors of production, and these include land, labor, capital, entrepreneurship. And households generate income from the sale of these resources when they offer them to firms. Income is generated in the form of wages for labor, interest for capital, rent for land, and profit for entrepreneurship. Households offer their resources in the resource market. This is a place where households and firms meet to negotiate the employment and sale of these resources or factor productions or inputs. Firms offer wages, rent, profit, and interest for the employment of these resources, which are costs to the firm. Firms utilize these resources as inputs in their production process to generate goods and services, which are sold in the product market. And this is a place where firms and households meet to buy and sell outputs or products or goods and services. Firms generate revenue from the sale of these goods and services, whereas the household is engaging in spending or consumer expenditure to acquire those goods and services. It should be noted that households seek to maximize their utility. Okay? And they maximize their utility by selling their resources at the highest price possible in order to generate the most amount of income, which will be used to buy goods and services at the lowest price possible. On the other hand, the firm seeks to maximize profit. And it will maximize profit by acquiring these resources at the lowest possible price or cost to the firm. So within a free market or mixed economic system, the price rationing system that appears within the resource market and the product market is the means to which allocative efficiency is achieved in the resource and product markets. The allocation of resources based on price being allocated to the firm willing to pay the most for those resources, and the allocations of goods and services being allocated to the household that's willing to offer the highest price possible. Now, it should also be noted that as households and firms engage in trade within the resource and product market, they are each better off in the exchange based on the belief that from their point of view, they are buying, in the case of firms, they may believe that they are buying the resources at the lowest cost possible, while the household believes that they are selling their resources at the highest price possible to the firm. In addition, the household believes that they are buying goods and services at the lowest price possible in the product market, whereas the firm believes that they're selling it to the household at the highest price possible. So due to a degree of asymmetries of information between the households and firms, both walk away better off, right? Because they have the perception that for firms, they've sold the product at the highest price possible, where the household has thought that they've bought it at the lowest price possible. And in the resource market, households believe that they have offered their resources at the highest price possible, where firms think that they've acquired it at the lowest cost possible. All right. All right, great. So that is what you would state and explain in a paper exam for micro. Now, there's something I want to add in terms of macroeconomics. And in macroeconomics, we're going to get into this idea of economists trying to measure production within an economy and deciding on how can we measure production year after year. So in this simple model of a closed economy, we can measure production in terms of spending. If a household has acquired some type of output, that means that that output has been produced. And so if we can track and sum up all of the spending by all households within a nation, then we get to a type of measurement that is known as GDP. So this is known as the expenditure approach. And so I'm just going to make some notes here for macro. Right? The expenditure approach is real GDP. And in that approach, we're measuring all of the spending within a nation by looking at all of the consumption spending, plus all of the investment spending, plus all of the government spending, plus all of the exports minus imports. So in the circular flow, when GDP is being measured, it's being measured right in this part of the circular flow, looking at how much spending is coming out of the household for final goods and services. And we use this simple formula called consumption spending plus investment spending plus government spending plus exports minus imports. In a closed economy, it can be assumed that spending should be equal to income. Right? If a household earns $100, then we will assume that they will spend all $100 on final goods and services. And this is known as the income approach, right? The income approach is known as gross national income. I'll state this as GNI, which is equal to wages plus interest plus rent plus profit. Income, if we can measure all of the income generated from the factors of production year after year, we can see the level of gross national income or productivity occurring within a nation over time. Or we can measure the level of spending, which in theory we're going to assume are equal to each other. And that's an assumption. We're going to assume that, again, if the household generates $100, they will spend $100. So if we measure either GNI or real GDP, real GNI or real GDP, that we can measure productivity over time. Because if there is spending, it should be equal to the value of the output. If output has been produced in a particular year, that represents production. And thus, if we can measure output, which be the sum of all final goods produced in the different sectors of an economy, the primary, secondary, tertiary, quaternary sector, then we can measure the level of productivity within a nation over time. So in theory, the three should be equal to each other in a closed economy. Output should be equal to the value of spending. If I spent $1 on a particular product, then the value of that output or product is $1. And on the household side, if they've generated $1, that's the value of their productivity. They've used their resources to produce forms of income, part of the production process on the side of the firm. So we're going to get into detail with this in macroeconomics of looking at the expenditure approach, GDP, particularly real GDP, and the sum of consumption spending, investment spending, government spending, and exports minus imports, and gross national income, as the income approach, where we're measuring wages, interest, rent, and profit to measure production in an economy over time. And that's it. If you have any questions, feel free to comment, and don't forget to subscribe and to like. Thank you so much.